This is a conversation that Tim and I have all the time with ourselves, with each other, with the rest of our team, at all sorts of different locations through the hallway to a meeting, to a setting like this. Something we've done before, but it's been a little bit of time. So we just wanted to share what those conversations could look like in hopes that we can shed some light on this topic a bit more. Now, Netflix does have a video years ago that they created. It's a fun video that does indeed have a lot of great content inside of it. We'll talk about some of the pieces that Tim and I don't completely love that's talked about in that video because it's still very confusing. But for the most part, it really does do a great job. That piece that I'm talking about is this idea of a discount. So the two biggest things that people probably come to us and bring up are confusion about this concept of a discount, which we're going to talk about, and is this money even real? It's a good question. It is real. It doesn't mean that everything you see is going to show up in your pocket the way you see it. We'll talk about that as well. And what we usually like to get into is this concept of a decision tree. Typically speaking, we get a ton of calls about this leading up to an earnings call, the day of that actual earnings call, and then shortly afterwards. And when it comes out, it's sometimes in a bit of a frenzy, if you will. The reality is that it's a very difficult blanket question to answer of what should I do with my options, because it really does come down to the individual household as to what makes sense. Hence, we've created a decision tree that we will go over in this meeting to help you understand the different components to think about, what those factors look like for each individual household. And then we'll talk a little bit about exercising and selling. So that's the base of what we're going to cover today. A quick quote here, from a planning standpoint, one of our favorite quotes to throw out there. Iron Mike kind of has it right here. All right, so let's start with stock options in general. Like, what is a stock option is a very fair question. In the most simple terms that we can place this, a stock option is really a right. It is a right to actually buy stock. So when you get stock options, whether they be supplemental options or granted options at Netflix, both can exist. Granted options were given to you. That stopped, I want to say, probably about 3.5, 4 years ago. And then you have supplemental options where you can allocate a certain percentage or dollar amount of your salary that will then go towards stock. They're not stock. It's not stock that you own. Again, it is the right to own that stock. You get that right by exercising it, and then you have the actual stock in hand. All right. So that's what a stock option is. Again, a right to own the stock. Let's kick them off here. Tim, what is this discount that people keep on talking about?
Thanks, Dan. Yeah, so the best way I can explain this is what it is not, right? What is this not? And this is what it's not. Let's imagine that we go and we're going to go purchase that shirt, right? That's on the rack that I've been wanting for a couple of years. And we go to the store and all of a sudden they're like, hey, this is 40 to 50% off the current value. And you're like, yes, it's finally on a discount. I'm going to buy this shirt. This is going to be awesome. That's not what is happening with the non-qualified stock options when you are doing supplemental options. The discount, yes, is referring to the exercise price will be at a discount, but in order for you to make a return on your investment, you need the price to increase by at least 40%. So it is at a discount. And I don't love the way in which the terminology is because people come to us and be like, yes, I can purchase Netflix at 40% discount relative to its value. And I go, if that were the case, we would be telling everybody to do this hand over fist because that's an amazing deal. It's just not what is actually going on. It really could be more seen as a cost of the option, and you have to recuperate that cost in order to start making money. So it's just, we have to be very clear about what that is so we don't get confused. The only time that we see where there is an actual discount to the market value of a stock is through what's called an employer stock purchase plan. And the most that can be is 15% discount relative to the current market value. This is not that type of plan, and that is not what is going on. So I'm happy to show the math. We don't need to go into details, but if anyone is curious about the math, happy to go through it. But it is not an actual discount, like I mentioned, relative to the shirt analogy. So
You did such a great job. Can you also talk about this two-step process of exercising versus selling?
Yes, we'll hit this probably a little bit more into the presentation, but there is a two-step process. Like Dan mentioned, we own the right to purchase the stock at a certain price. So if we decide to exercise our option, meaning, okay, Netflix, we now want to buy this stock at this price, that is called exercising our right or our option. Then we have another part of the process. Do we want to then go ahead and sell out of that stock that we now own and turn it into cash? Or do we want to hold it? So it is a two-step process. What sometimes gets a little confusing for our clients is that you can wrap that process all into one trade. You can say, hey, I would like to exercise and then immediately sell all in one fell swoop, but it is going through that two-step process. You just don't see it. So the reason why I bring this up is our clients will be like, well, Tim, I don't want to sell it. I'll be like, I understand. That's okay. We can actually exercise and hold, or we can exercise and sell.
Long and behold, the decision tree that we spoke about. We're going to step through this process. Again, a lot of times people are coming to us thinking the decision is solely about price. How would you know any different, right? But in all reality, there's different steps within the tree, different metrics that we're tracking that are going to lead to whether or not we think something should be done. In a sense, you have options for your options. And with inside of that, as Tim's going to talk about here at some point, heck, maybe he'll even do some of that right now, is that there are such things as cashless exercise and there's cash exercise. In fact, Tim, maybe you can shed some light on that, and then I can kind of hit on point number 2.
Sure. Yeah. So when you exercise, you have the ability to go to exercise in two different ways. I love how Dan said you have options for your options. So one is, hey, I can bring actual cash to the table, which means in my bank account, right? Let's say in order to exercise, it's going to cost me $20,000. In my bank account, I have $20,000. I can take that $20,000 and then I can go ahead and purchase those stocks, right? Or I can use the embedded gain that I have, and I can use that embedded gain to exercise without actually taking my cash out of my bank account. And what happens is then I have a reduced amount of shares or cash at the back end. To be very frank, a cash exercise 99% of the time is not going to make sense. You really probably want to go the cash exercise route. Now, we don't need to go into details on which is which, but if you are curious on why that makes sense, always happy to talk about it. But again, a cashless exercise is typically what we're recommending, not a cash exercise for a litany of reasons, but that might be a little too in depth for today.
And speaking of cash, in all reality, if you need the cash, that's the first step in the tree. And sometimes you do. Sometimes it makes sense to go into this bucket and use it if we're looking to get into a home, if we are in a crunch for whatever reason. There needs to be a consideration of need and also best usage from other ways to leverage debt and leverage cash. And so sometimes the tree is a short tree, it's a shrub, and it's simply you just need the cash. Now, if we can get past that piece, we start getting into some actual metrics that we really do harp on. The first one being concentration risk. Tim, I yield to you on concentration risk.
Yeah, concentration risk is something that we're always paying attention to, and what concentration risk is what we will do is we want to look at all of our assets that we have, mostly investable assets, 401k, a brokerage account, other stock options from other employers, right? Past employers. We want to take all of that, say, what is the value of that? And then what is the value of our Netflix qualified, non-qualified stock options? And what percentage of our Netflix non-qualified stock options make up of our totality of assets? If that's greater than 10%, Dan and I are knocking on your door if you're a client. Hey, this is highly concentrated. We need to pay attention to this, right? If you were to look at a portfolio, typically speaking, you're not going to see people with greater than 10, 15, 20% concentration. Even with institutional money, like professional investors like ourselves, we will say, hey, that's putting a little bit too many eggs in that specific basket. We want to bring it down. Now, what's nice about this concept and these other concepts is we're not focused on price. We're focusing on the risk side of things to say, hey, let's bring this concentration risk down. And then we may sell and take the cash, let's reinvest that cash into a more diversified portfolio to mitigate that concentration risk. The last thing I'll say about concentration risk is if you are an employee at Netflix, you are concentrated more than just your non-qualified stock options. Your W-2 comes from them, your insurance benefits come from them, your 401k match comes from them. You're concentrated within Netflix at a very high rate, which is something else that we just have to pay attention to and just be aware of, to be very honest.
In all reality, this is a measure of vulnerability. So the more concentrated that you are, the more vulnerable you are to price changes in that stock price. So it's done really well for the most part, minus a little blip maybe 2 years ago, over the last 7, 8, 9, 10 years for Netflix individuals holding these options or stock itself. But it's about being susceptible to what those movements look like. It is not uncommon for us to have a client that has 50, 60, 70% concentration in Netflix. That part is definitely a concern. Like Tim was saying, 10, we just wave a flag. Hey, consider it. We're not afraid of concentration. It just got to make sense for what that person is looking to achieve, right? Expiration date is a really big component to these options. At Netflix, you have 10 years for when these are issued to you to exercise based on that expiration date. That's a really important consideration. Tim's going to tell us why.
Yeah. So if for some reason we decide, hey, Tim, we're gonna hold on to these things all the way up to the 10 years and we're not gonna exercise because we think the price is gonna go higher. I'm gonna say, we need to exercise. And the reason why is if we let it lapse, if we go past the expiration date, it is worthless. Doesn't matter if it's 100 grand or a million. You no longer have the right to purchase that stock. You do not own anything. Remember, an option is the right to purchase a stock. Does not mean you own it yet. So we have to pay attention to make sure we exercise before that expiration date or it turns worthless. The other thing with expiration date, which I'm going to go a little ahead of Dan here and talk a little bit about taxation concerns, is that when we exercise, we are creating a taxable event. You have your exercise price and the current market value. That difference, right? That gain there is what's called a bargain element. The IRS considers that income, not just income, but W-2 wage income, which means that that income is going to flow through and it's going to be taxed by federal, state, Medicare, Social Security, California SDI, right? It's going to be taxed on that level. So reason I bring that up is if we wait till the end of our expiration date, we may be where we are forcing ourselves to exercise and create a large taxable event, which we could mitigate if we are looking at it over the years. So typically, we're always saying, hey, 5 years left. Let's make sure we're starting to pay attention to see if we need to start exercising so we can actually break that taxable event up if we need to. So it's looking at it from a tax lens and then also paying attention to the expiration dates.
I'll sprinkle a couple of thoughts on Tim's 2-for-1 deal between 4 and 5. The other thing to kind of consider here is if for some reason that doesn't happen, absolutely exercise. Because again, if your 10 comes by and you don't do it, it's worthless. That does not mean you have to sell. You can exercise these options, make them into stock, and you can hold them in stock form for the next however long you want, decades if you so choose, but you don't want to miss that window. But ideally, like Tim is saying, 5 years hits, we got to start thinking about it because in years 7, 8, 9, and 10, you may want to piece these things apart depending on what taxes look like, and that can best be assessed by looking at a tax return. The other thing from a taxation thing to consider here that people get awfully confused about is, again, we are talking about 2 different taxable events. We're talking about taxes triggered when we exercise, and we are talking about taxes triggered again when we sell. Those scenarios can look really different because if we were to, for example, exercise and hold that stock for less than 365 days and then sell it, we will be looking at ordinary income tax. If we can hold after that, we are looking at long-term capital gains. That is a major difference from a tax standpoint, but there are other risks, like risk and price, for example. Again, concentration risk that we already talked about that come into play. Realization rate is a concept that if you're a client of ours, you have heard this before. If you're not, it's maybe the first time you actually hear about realization rate. So Tim's going to shed some light on realization rate.
Yeah, happy to go through. I might go through this a little fast. I know we're running up on time. We want to leave time for questions. So I might be quick, but again, if anyone has questions, please by all means just reach out to us. But realization rate, really quick. We use what's called the Black-Scholes model. Black-Scholes actually won a Nobel Peace Prize for their model. Their model was to value the value of options. What is an option contract worth? So what we do is we use that model. There's a lot of inputs to it to see what these options are actually worth. We go lot by lot. So each granted option you receive, we understand what that realization rate is or what the value is. We then compare it to what is it actually worth right now? And we figure out how much of the value we've actually realized. If we have realized more than 90%, regardless of price, Dan and I may say, hey, look, options, good job, pat on the back. Let's exercise. Let's make sure we turn it into cash. Let's make sure we put it into stock. Let's now own this. Again, as Dan pointed out, we can exercise and hold, or we can exercise and sell. But it's a really nice metric to pay attention to where we know now, regardless of expiration date or others, that we can actually turn this into stock we own and or cash.
Considerations as it relates to future price is really tough because it's speculative in nature. We'll have, I don't know how many conversations just throughout the course of the year on this topic, but definitely an increase leading up to that earnings call, again on the earnings call, and then shortly after in that window before we head into foreshadowing a blackout period. And really, if we have 20 people ask us, what they should do, and we will ask them back, what are your thoughts on the future price of Netflix? We might get 25 answers. So in all reality, you probably have a better perspective on this than we do because many of you are living that day to day. But we're always happy to help from a being a devil's advocate standpoint, push it back and forth as we try to stay up on it. But in all reality, that's the hardest judge because it is a gamble. The rest of what we talked about, okay, there is some art and science behind that. But where the price goes, nobody really knows. Okay, a couple other pieces that we just want to hit. So we've gone through this tree. We've decided, okay, we're going to exercise and maybe we're going to sell. What happens next? We've already talked about expiration dates. So I'm going to talk a little bit about this idea of a blackout period and what is that? I'm sure people are familiar with this concept. It means you're locked out for the most part in actually making these transactions. Now that differs. That's not hard and fast. So a blackout period is going to happen leading up to an earnings call for employees, that is. And then the next day afterwards, you can actually do something. So in this case, the next earnings call at Netflix is happening next week on April 18th. So up until then, boom, you can't do anything. On the 19th, you can if you're an employee. One caveat to that. Technically, if you're an employee, you can still exercise, even if you are in a blackout period, but you can only do a cash exercise. Remember, Tim was saying you bring cash to the table to make that happen. Usually, we find it doesn't make sense to do, but you could. Of course, then you still can't sell the stock. So you're still taking that risk of what happens in that time frame to that stock once you actually exercise it. If you're looking to do a cashless exercise, you can't do it until you're out of blackout period. Just what it is, and nobody sells the stock. If you are no longer a Netflix employee, but you still own these options and stock, blackout periods, they don't apply to you anymore. You can sell, you can exercise whenever you want. I'll pause there. Tim, people get surprised often when they look at this after the fact. They say, whoa, that showed me this value, and now it's showing me I get this much. Why is that?
Yeah, because they take into consideration your tax withholding. So like I mentioned, this is W-2 wages, which means they're going to be taking a lot of different taxation away from it in order, and they do the withholdings on your behalf. So when you go ahead and exercise and or sell, right, you can do it all in one fell swoop, they're going to take approximately 42% of that overall gain. And they're going to do that for withholdings. The good news is that you're not usually going to be stuck with a tax bill. Now, I can't say that with a straight face because there's a bunch of different reasons on why you may have a tax bill or not. But for this specific reason, the withholdings typically do cover the amount that needs to be covered, which is great. So you don't have to feel like you have to come up with something at the end of the year. Now, the one thing I will mention too is this IRS letter. We have had this happen enough times where we need to mention it. What happens sometimes is we exercise. A year or two later, the IRS comes back and says, hey, Dan, remember when you exercised? You owe me 50 grand. And Dan goes, Tim, absolutely not. I thought I paid for this. You told me I did. And what happens is that the IRS is receiving inaccurate information from E-Trade and or Morgan Stanley now, and they're providing this information without any cost basis, and all of a sudden it makes it look like you didn't pay income tax on a large amount. Now, what we then do is go with your CPA and or together write a letter and say, hey, IRS, this is actually not what's happening. Here's the documentation for where it is. It actually did come through my W-2 wages. You need to recorrect this. Every time we have done this, they have come back and said, okay, that's our mistake. Thank you for providing the information. Then they move on. So every time our clients, I get a frantic email saying, Tim, I owe this money and where am I going to get it? And then we usually make sure we get it corrected. So just pay attention. It may not happen to everybody, but I've seen it enough where we need to at least give it a shout out.
But wait, there's more. Last step here is you got to move the cash out of Morgan Stanley E-Trade. So sometimes people will be like, "Hey, we did this. Did it work? Because I don't see the cash." It's there. It's going to sell then into that E-Trade account, be held in cash. You do have to take the extra step of then moving it to wherever you wanted it to go. Okay, we got about 6 minutes. It's great. I only expected 5. Any questions? We'd be happy to do our best to provide answers. And you can put them in the chat, and our fearless leader Ying will be receiving them, and we'll ask them on your behalf.
Oh, we do have a question. Oh, I guess we didn't really touch on that. So the question is that when I exercise, is there a difference between granted or supplemental options?
Good question. Do you want me to handle that one, Dan?
Go right ahead, Tim.
Okay, good question. So the answer to that is no. There really isn't a difference, right? What we really can't tell is which is supplemental and which is actually granted. Now, we really do want to try to pay attention to it because, like I mentioned, this discount that people talk about, when you do buy supplemental options, you really need it to increase again by 40% relative to its exercise price, right? In order to make a return on investment. So tracking that, which funny enough, Netflix back in like 2020, 2021 had a spreadsheet to track it, but it is important to track so that we do know that we had some return on investment. However, it is not identifiable through the platform of E-Trade / Morgan Stanley. So just something you have to pay attention to, but there isn't any other difference. Things are going to look very much the same. And again, if you didn't work with us, you had no idea, you would have no idea which one is which. Just put it.
Yeah, great question.
Yeah.
Any other questions? We know you're busy.
The same participant has a follow-up question. With today's price, should I buy more supplemental options? If so, when should I do it?
Yeah.
Options. Yeah. So that's a great question. And I think Dan would probably answer this the same way as it's very personal to the household. It depends on where your cash is at. It depends on your situation. This is what we do with clients when they come in is we actually analyze what is our cash, what is our goals, what are we doing, what are other options, what other things that we do have. Are we maxing out our 401k? Are we doing our after-tax, contribution to truly max out a 401k? Do we need money more liquid? Do we need to be more diversified based off what we already hold? There are just a litany of different things that we analyze and assess. So to say, hey, yeah, go ahead and do supplemental options. Dan and I hate giving broad-based advice because it is not that straightforward and it really is more personal to the household based off goals, situation, net worth construction. So I would say that please just talk to us and ask, and we can help you answer that question. I don't know, Dan, if you have a different answer there, but
I mean, I think it's a great question. It's one that we do get from time to time. It's tough. Sometimes we talk about this concept of, because there really is real risk with a supplemental option, like we were talking about earlier. You have to get to that strike price for it to actually have that value. Tim was talking about that when he was explaining the difficult concept of the discount. So it's not like the granted options that some of you may have received at one point where you're already there. So there is a risk to it. To some extent, sometimes we talk about this concept of FU money. You could figure out what that stands for. And really it's a second tier thought process of where do we invest after we hit some other pieces. Like Tim mentioned, for example, your Fidelity 401k. From a tax standpoint, an overall growth standpoint, we would look to fill up that bucket first before going there. And funny thing is, most of the time, I think all but once have we ever had a conversation with someone most people think they're filling up that bucket in the 401k. They're not. So in all reality, that might be some place we would recommend going first. But again, like Tim said, very individualized. We'd have to dig a bit deeper into it. It's just maybe, I guess, is the answer. Nothing else? Okay, well, you know how to get a hold of us if you so want to. But again, thank you for your time today. We hope that you had as much fun as Tim and I did in bringing this information to you. Have a great weekend. Talk again soon.
Thank you, everyone.